Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show. And so today I like to welcome Chris Reilly for the show. Hi, Chris.
Hey, Axel, how you doing? Thanks so much for having me on. I appreciate it.
Absolutely. We are very glad that you could make it and that you want to educate us a little bit about the cool stuff that you're doing. So before we get into that, I saw that you had some work after Lehman Brothers collapsed to work on their bankruptcy stuff. So maybe we start there and you tell us a little bit how you got into that, and then from there, how you got to what you're doing today.
Yeah, sure. So the Lehman bankruptcy, I was working for FTI Consulting at the time. That was my very first job out of college. It was in 2009, so 1 year after Lehman filed. Lehman was a client of theirs, and part of my job was to go into the actual Lehman building and help unwind the derivative portfolio on behalf of the unsecured creditors committee. So I learned to use the Bloomberg terminal and a lot of initial financial modeling skills to help value these contracts, and that was all part of this orderly liquidation process. So I did that for about a year. It was a really interesting engagement. And then from there, I went to Hilton Worldwide, the big hotel chain based out of Virginia, in more of an FP&A value add role, and eventually took a full-time job there in their treasury and FP&A department. And at Hilton is where I got my first exposure to private equity because they were owned by Blackstone at the time. And I became really interested in this whole private equity concept. And so in my free time, I taught myself how to build the LBO financial models that are the bread and butter of the industry, and just the whole deal, like how it all works. And then I was fortunate enough to find a company out here in Denver. This was almost 10 years ago now, that was willing to take a chance on me because I had a non-traditional background for private equity. Usually, it's investment banking is the most traditional, and I was had a consultant and corporate finance background. So they took me on, and I did what's called middle market private equity, which is smaller companies, usually 200 million or less in revenue, for almost a decade. And then in 2020, I went out on my own as a financial modeling educator and contractor. And that's what I do now. Primarily day to day, I help people build fairly robust financial models. And I've had my work featured on the Wharton Online Private Equity Certificate Program, which I'm really proud of, and also Wall Street Prep and LinkedIn Learning. So that's what I'm doing today, teaching financial modeling.
Cool. And when you say teaching or helping people, what kind of people would be in need of financial modeling, just to start somewhere to say, okay, before we dive into what it really is, but who would say, hey, Chris, I think I need some financial modeling. Can you do that for me? I mean, I'm kind of trying to imagine, what would be my trigger, or who would be wanting that and needing that.
I would say so. It's probably a core skill for anybody who works in finance and probably accounting as well. But really, if you're faced with the situation where we have some historical data about the past and we need to make some kind of reasonable estimate about the future, the way that we typically do that is by building a financial model. And so if you're faced with that scenario, that's the time when you say, okay, I need to at least develop some basic financial modeling skills.
Okay, and so if we take this just for a moment to say, one thing that I hear where people use the term model is when I go to like CNBS and there's somebody interviewed as a so-called analyst for a particular industry or a particular list of company stocks. And oftentimes they say, yeah, we put our financial model together and we're basically predicting the estimated earnings for 2024 to be $3.50 or something. Is part of what you're talking about?
Yeah, so I typically don't do financial models for public companies. I just do usually private companies because of my private equity background. And then I'll also do what are called operating models for private P&A companies. So basically anything that's non-public. But what you described is another element of financial modeling. And I think one of the things that's always frustrated me about financial modeling the most is that it's very cryptic, it's very opaque, and it's not really know like what it means. It's maybe something to do with
Right.
spreadsheet, not quite sure. All it really means is we use typically some kind of spreadsheet program, which for me is Excel, but it could be really any program. And we're just making guesses basically, about the future of a company and what it's going to look like from a revenue and cash perspective. And that is our model. So that's all we mean when this term gets wrapped up in financial modeling. We're just guessing how a company is going to perform in the future, and Excel is typically the program to get that done.
Okay, and so when we make these estimates, the purpose for people to make a more informed decision based on the quality of estimate, I guess, is how you could put it, to make an investment in any of those organizations, or what's the main purpose for the modeling?
So there's several purposes, but on the private equity side, it would be what you said. It would be, do we think the company is going to perform well enough that we can make an investment or acquire it? On the FP&A side, which is for financial planning and analysis, that's just trying to see, well, how well do we think the company is going to do over the next 12 months or so, and what kind of cash is it going to generate? And if the company has usually a board of directors or some kind of lender, a budget is required at the beginning of every single year, and so the model helps put together the budget, and then through the rest of the year, we can compare the actual results to that budget. So it models have a different thesis and what they're solving for, but in some way, shape, or form, we're trying to make an estimate about the future so that we can have our operations teams, go to work and do what we have to do today to achieve those results.
Okay, and if there's a guy that comes along and says, "My name is Jerome, and I'm gonna just quadruple or quintuple or something like that, the interest rates," what happens to the stuff that you calculate?
Well, if the company is debt-based, the very first thing is the interest expense is going to go up theoretically. It depends on what kind of agreement they have with
Right.
their lender. If you're looking to do some kind of acquisition or private equity deal, it's just going to make the deal a whole lot harder because the interest expense is going to be a larger chunk of cash that that company has to pay. And what it usually does is result in just less deal flow overall because the cost of capital is too expensive.
Totally makes sense. But isn't there also like an overall economic environment impact? Like, to use my Tesla example, because obviously it's not only any money that people, for example, need to lease the car or finance the car is affected. But in general, when everything is basically getting more expensive because of interest rates, then just the fundamental willingness to make a purchase goes down, right? Is something like that going into your models too, or is that too unpredictable?
I'd say that's a little bit too unpredictable. What we might do that tackles that, but in an indirect way, is we'll just say, okay, interest rates are way up, and you're right, that's going to affect people's buying decisions at home. We might just run a downside scenario alongside the revenue, and so we're going to say if the interest rates go up to X, well then let's factor in, a 20% drop in revenue, and all in, that's one scenario. And what does that do to the bottom line of the business? So
Right.
that's kind of an indirect way of building in macroeconomic factors without overly complicating it.
Right, yeah, or there could be a war somewhere breaking out unexpectedly or something.
Yeah, yeah, exactly. You always want to build your models to have some kind of massive downside black swan event. I mean, I could tell you that probably zero people factored in COVID into their financial models a couple of years ago, but you
Right.
need to at least have a plan in place if there's an 80% drop in your business, just so you know what to do. That's really the whole purpose. It's unlikely that it will happen, but you want to have the plan because, the founders need to know what to do, the employees need to know what to expect, and you have to know who's going to stay and who's going to go and kind of how the company's going to operate. So that's the purpose of like a pretty material downside scenario.
Okay, and then so you mentioned that example. Is it likely that I would say the bait is still even this couple years out after out if it was really a V-shaped or a K-shaped recovery, but does modeling do anything like that, or is it basically when it gets so extreme you can't really use the models anymore, or are the limits to that?
Yeah, I think the model is not there to predict that sort of thing. At least the models that I work on don't predict that kind of stuff. My models are there to kind of react to either one of those scenarios and say, well, what would happen if either, is a V or K or something like that. That said, I still think all of that is kind of a guess. Even the models that are designed to work on that sort of thing, that you can't really model the the irrationality of human behavior and the unpredictability of human behavior. So I think the best you can do from a modeling standpoint is just build in potential scenarios of something that we don't expect, because whatever that event is going to be, most likely it has a downside impact on your company. And so no matter what the headline is, kind of the modeling impact is similar.
Yeah, okay. Well, I'm a little bit skeptical because when you said decisions that human beings make, I'm totally with you. But if these human beings are in powerful positions, right, and say, hey guys, I feel like I want to throw $2 trillion into the economy, that's not necessarily all detriment, right? That could also be, if your name is Pfizer, for example, or Moderna or something, that could be a huge win, or all the organizations that basically got free money very quickly. I think that the interesting part for our audience is to say, okay, these human things, I have the impression, honestly, that there are certain things that you can say are reasonably to be expected. And then there are these complete outliers where somebody suddenly has the idea we can generate 25% of all the dollars ever generated in 4 years. I don't think anybody could say, yeah, that's very likely. Let's do a scenario of that. Right.
Yeah, I think you're always trying to be reasonable and conservative. I mean, the thesis of the model ultimately is let's keep the business going, let's keep the lights on. So let's be thoughtful about the future. Let's do our best that we can, knowing things like human behavior and our customer profile and whatever else. Let's give an accurate guess, but then let's shave a little off the top just to be conservative and factor in unknowns. And again, the goal is not to have a perfect model. And I know sometimes people would disagree with me there. Really, you just want to be operating in a conservative scenario so that your operations team kind of, knows what to do and you have a playbook by which you can operate. That's really the thesis. It doesn't have to be this perfectly accurate model that's designed to predict the future.
Right. Yeah. So I think we have established a little bit what it's for and what it can do and so forth. Would you mind giving us a little bit, like maybe tell a story of a case without naming names, naturally, where you say, okay, here is an organization of this kind. They are interested to get modeling started or get proper modeling done. And how does it go from there? And what are basically the benefits of doing it?
So, yeah, a lot of times I'll work with software companies that are very early stage. Sometimes they're seed funding or Series A funding. And, maybe they just have a bookkeeper or light accounting staff, and thus far they've just been closing the books, like in QuickBooks, making sure there's cash in the bank account and just continuing to operate. But
Right.
what happens a lot of times for these early stage companies is they need a big infusion of equity to keep going, 10 or $20 million. And what you need is you need the financial model so that investors have a general sense of, okay, if we put $20 million into this business, how many months of runway does it give you as the company? So suddenly you've gone from closing the books to now coming up with a 4-year projection by month so that the investor knows, okay, when I invest this $20 million, you have 20 months of runway, if their burn rate is $1 million a month before you either need to become profitable or we're investing another round of equity and I'm potentially getting diluted. So investors need to see that playbook and see the vision and knowing that it's never going to be perfect. Nobody
Right.
can predict that far in the future, but reasonable enough to know that, okay, I will hopefully make a return on this investment and the company will be worth something in the future. And the model kind of helps them set the goalposts for that need. So any company that's early stage needs that playbook before any investor is going to take them seriously at all.
And can you say a little bit, who would we have to imagine that investor community to be?
For early stage, that might be as friends and family could be the earliest. They may not need a model. Most likely, though, when you want a more sophisticated model, you're talking about angel investors or venture capital. That's typically who's going to come in the earlier stage. Later stage deals is going to be a growth equity company, which is sort of a blend of venture capital and private
Right.
equity. And then later stages, traditional private equity, where the company is already cash flowing nicely and it makes for a nice acquisition target for a majority investment. And that's where you could do an LBO or like a traditional majority buyout. But typically, it's those kind of investor groups that are coming in. And for software and Series Seed or Series A, it's typically venture capital.
Okay, yeah, very cool. And I assume you have to have a pretty reasonably good understanding on what it means, for example, in the software industry to put something together and have some expectation of success, because it sounds a little bit like you have to kind of interview, I don't know, the founders or the core team or something like that to find out what do they actually, or what have they been doing, what are they planning to do, and how realistic is it, right?
Yeah, absolutely. So the first part of building the model is just getting the plumbing right. Just like in a house, you got to get the
Yeah.
structure so that as we make decisions, I at least know that it's going to be functioning properly. But then 80% of your time is spent with the founding team, the management team saying, how are we going to grow? What's going on with this contract? How are we going to figure out all of the people that we're going to hire? Are we going to do FTEs or headcount? And we go
Yeah.
down, every single line in the company and come up with a very thoughtful plan for each and every line because an investor is ultimately going to ask. And if the CEO doesn't have an answer, then that's automatically a red flag. So it's a very recursive process to educate the management team on their plan because they need those sound bites for the investor group. And then what ends up happening is it also serves as a great internal reporting tool because you can update it every single month. And now the team also has a month to month playbook that they can use for their reporting purposes that can also double as an investor presentation.
Okay, yeah, very cool. So I would assume then that if any kind of rumors come along, that stuff might change. Like you mentioned, FTE versus headcount, right? And the government says, well, we want to make it harder for people to be contractors. That would then probably have like a second scenario where hiring contractors is no longer really advisable or not really cheaper or whatever somebody might think, right?
Yeah, absolutely. And so usually the most scenarios in a model come from putting some kind of variability on revenue and then on headcount. And so a lot of times we'll have individual names in that headcount roster with toggle switches of on or off, whether or not we can hire people. The same idea with contractors. And you're always adjusting your model to kind of fit the latest set of information that you have.
Okay, and then I mean the community, and I hope that there are many of our audience members who could do 20 million investments, but a little skeptical. Is there a minimum where you can say, okay, the angel investor interested in something like this and be willing or interested in seeing the model starts at what kind of investment volume or number?
I don't think the model has to gate any kind of investment amount. I think it's reasonable for anybody putting in money to any company to ask for a model. If it's $5,000, it may not be overly reasonable. But I'd say anything sizable, one to $200,000 is a very reasonable request to say, hey, do you have a financial model? Unless you're kind of playing with complete funny money and don't care, then that's a totally different approach. But I think any company at some point has to self-manage through some kind of financial model, or ultimately it won't survive. So it's really sort of a means to an end, and I don't think that the financial model has to prevent anybody from investing or bring them up to any kind of minimum threshold.
Right. I think it's probably still worth for the audience to realize this is probably more in the accredited investor field, VCs and stuff like that, right? I mean, this is not where you put your money that otherwise goes in the savings account or things like that. At least suggest not to do that.
Right, for sure. Yeah, typically it's accredited investors, but a lot of these private deals are becoming more accessible to people that aren't accredited just based on different platforms because people want exposure to the private markets. But typically, yeah, the standard advice is, and this is not financial advice, but just what I,
Yeah, right.
the common what I hear is you build up the savings, you build up your easy investments through 401k and your index funds, and then once you have a comfortable nest egg there, then you can start thinking about allocating capital to the private markets because what happens is when you do a private investment, your money is locked up in that investment for an unspecified period of time. There's also likely fees that come with it, and you're hoping for an exit down the road. Whereas if you're in the market in an index fund, you can liquidate your position anytime from your computer. So it's a whole different ball game, different tax situations too with Schedule K1s and that kind of thing. So it's only for somebody who knows what they're doing and kind of what they're getting into, but it still is a giant market, this market of private investment.
Yeah, absolutely. And I mean, the economy and anybody who is starting something new, and I still have to say, I cherish this about the United States that this is probably not quite as prevalent anymore, but the fundamental statement about land of opportunity from the perspective of having an innovation and turning it into a scalable, scaling business, I think that is still very, very true and very much happening. But it obviously takes funding to, especially nowadays, to make it happen, right? So now you mentioned the word exit, a successful exit. I think almost anybody can imagine that. But what's the likelihood of a successful exit, and what would you say? would be considered a successful exit?
The likelihood, I don't quite recall. I used to have those stats in my private equity days, but I don't really remember them anymore. What I vaguely remember is, let's say that a company, a PE firm invests in 10 companies.
Mm,
You might have one of them that's a complete home run, a handful that are okay, and then two or three that really just don't do well at all. And then the home run deal is going to kind of return the entire fund with the middle tiers kind of just filling in the back end. And I think that's the venture capital model too, other than that 10 investments might be 30, because they're just
yeah,
taking flyers on earlier stage companies, but usually one or two home runs kind of returns the rest of the portfolio. And a successful exit, what that means, that really comes down to the person investing. Ideally they would love to make a greater return on their money than they could have made in the stock market because they want to
right.
be compensated for the lack of liquidity and the lack of insight. So I'd say that's a best case scenario. But some people, after a bunch of years go by, they just want to get their money back. You never really know what successful looks like. But I would say on paper and in a building from a financial modeling sense, if I'm going to put my money in the stock market for 5 years and let's say I can maybe get 7 to 10% a year, then a successful private investment, I want that same number to be 25% per year to compensate me for the risk and
Right.
to compensate me for the lack of liquidity. And so that's typically what we would model in like a classic PE deal as a starting point.
Yeah, absolutely. I mean, and I think one thing that I've seen, and I've only really scratched the surface out of coincidence, basically being part of sometimes projects where I'm in a consulting role or advisory role, not for financials, but for more operational stuff, where it's really also, I think, very dependent on the industry, right? Like I've consulted in an organization in the pharmaceutical industry. The overall investment was probably close to 150 million or something like that. But then what started out as kind of like a lab experiment and took almost 10 years to get to actually FDA approval and all that other stuff ended up being sold for 4.5 billion, right? Like, so now they didn't just put 120 million and then never do anything for 10 years. There were, like you said in the beginning, there were multiple rounds, and I don't know exactly, but I think rumor has it that there were between 3 and 400 million total that went in over the time period. But then 4.5 billion is like 10 to 12x. That's not bad, right? And they were all pretty happy about it. So
Yeah, yeah, I'd say that's definitely a home run. And to give you like the 10 to 12x, the multiple you just outlined, the 25% that I just mentioned over 5 years comes out to be about a 3x.
yeah,
And
yeah,
so that's like a nice standard target for a later stage private equity deal. In the VC world, you're going to be looking for some of those, 10x pluses to return the portfolios, and some of the real home runs can be, 100x, something like that.
yeah. I hear you. I mean, the other thing is when you say like 3 to 5 years, and then in this case, that I was part of, and I wasn't on the executive team or had any kind of significant shareholdings or stuff like that. But I mean, a little more than 10 years is also, if you take that in the same comparison, you would say your 3 to 4x would be probably reasonably become 6 or 8 if you have to stay that long. And that's what my point was, basically to say for our audience, be aware it's not the same when you have a product that after it's been developed and then goes into marketing can basically gain market share quick like a software. If you have a medical product or a medical device or something like that that goes through all kinds of tests and human trials and approvals and what have you, then 10 years is a long time, but it has at least the potential to, you said, become a home run. It's just industry specific a little bit how long something takes. Yeah.
Yeah, definitely. And I think that's all part of the investor diligence going in is kind of knowing what kind of time horizon is reasonable and then also factoring in, well, what if stuff doesn't go according to plan? Then what's sort of the even more reasonable or likely timeline? And then you factor that into your overall return profile. And then that's part of your decision of, is my capital well placed here or is it better placed somewhere else?
Cool. Now, are there any other things where you would say, okay, we talked about the modeling and what it does and what it's for and so forth. Are there any other things that you would like the audience to know about it?
Yeah, I would say for somebody who's just starting out, I wouldn't worry so much about the sophistication at the business level. The best way to learn modeling is to build a personal budget for yourself. And that's actually the way that I first learned. I just wanted to figure out our family expenses and what our cash forecast might look like as a family. And you teach yourself tons of spreadsheet skills that way. You teach yourself cash flow forecasting and a bunch of other really applicable skills that you can learn on the job. And so I would just say open an Excel sheet and start there. That's really the easiest way to do it. And then as you get more sophisticated, then it could be time to, look at some of the resources that I offer that help more evaluate the business level of things, 13-week cash flows, three statement modeling, LBO modeling, but that's after somebody's had some basic exposure to spreadsheets, some practice figuring out their own personal life and their personal budget. And I will say the personal budget that I built way back in 2009, I've created multiple versions of it over the years, but I'm still using it today, basically, and I use it to manage our family finances, and that's 15, 20 years ago. So it's a great discipline that can stay with you throughout your career. So I would definitely start there.
That's very cool. And is there a particular group of people that might be in the audience where you would say, yeah, if you have such and such a need, then here's how you get a hold of me?
I think the best way to look at the offerings I have is my website. It's called financialmodelingeducation.com. There's tons of self-study courses there that have been very well received by people in finance and a lot of like blue blood names in the industry. If you want to get in touch with me directly, I'm really active on LinkedIn and on there almost every day, and I try my best to respond to messages on there. So I'm always open to questions, and I always like to connect with new people. I don't really like to be a ghost that's behind the scenes. So
That was actually something I wanted to ask you because I have like about 5,600 connections, and that's already a lot of birthdays and anniversaries. That you have 85.
well, I don't do birthday wishes anymore, but I still manage the whole thing by myself. I write all my content and I do all my comments and I do all that on my own, making sure that it's scheduled and I'm just sort of on there every day. And so
Yeah,
yeah, I'm
I
not
get
wishing
it.
people birthdays, but
Yeah, I have to start following you and see what you're posting, and maybe the rest of our audience is also interested. Chris is on LinkedIn, and cool. With that being said, I always ask two questions at the end of every interview. The first one is, if you had a time machine, where would you go and why?
like this question, I just saw it before we got started. Keeping it in the business realm, because I'm sure there's all kinds of personal things I could
Sure.
say. But in the business world, I go two places. One would be because it's my time machine, so I can go two places. I would go I'd go back to the very beginning of my career and tell myself that I'm not just sort of working a job, but really what I'm doing is I'm gathering data for what I like and what I don't like. And my goal is to focus on a skill that I could potentially market on my own in the future. And I say that because I came to that realization indirectly as I started doing this financial modeling. And so if I had had that little bit of that focus of let me really get good at a skill, that opens me up to the world of entrepreneurship later in life if I want that. And then my second time machine stop would be a couple of years ago in 2020 when I became an entrepreneur and started working on my own, would be to market myself right away online. I spent almost 2 years just doing word of mouth referrals through my existing network, and I got clients that way. But I didn't really get active on LinkedIn until 2022. And I was very fortunate that that following grew and I was able to generate a lot of leads. But I really wish I had started 2 years earlier because attention is really the ultimate currency that we live with today. And if you want to build any kind of company, you need an online presence and you need some traffic. You need that top of flow funnel to generate your leads and keep your business going. And I'm just kicking myself every day that I wish I had started 2 years earlier. So can't hurt to just keep the funnel going, keep the content going, and then as it resonates, you can really start to build a business around that.
That's definitely good advice. I mean, I'm kicking myself that I didn't start real estate 20 years earlier. I hear what you're saying. The other thing, the first part, the first stop that you mentioned for your time machine, I think there is a really profound message in there. Not just in, as you described it for yourself, but I think for anybody who is a parent and has kids that getting to this point like high school. And when I'm looking around, there are so many opportunities, not just for entrepreneurship, but also to do something that you're really passionate about and not just to continue for another 4 or 8 years getting a university or college education. And I'm saying this because I've worked with so many people in all kinds of companies, and when I ask them what they studied and when I look at what their job is, it's very rarely even remotely connected. But I'm sure if they were more encouraged to say, really think and pay a little bit attention of what you really like, what you really like to do, and then maybe have the option to turn it into a business later. I think that's great advice. So I thank you for that. Now the
Yeah,
other,
what you brought up is really important because I went through what you just described. I think when you go to school and you're young, you put in the time, you complete the tests, you get the grades, and then you move on to the next level. And I think that mental training gets reinforced as you get into the jobs. Okay, I go to the job, I guess I do work, I do some salary, and I guess I get promoted eventually, and that's just kind of what people do. And it continues that thought process from school. And it took me a really long time to realize that's just part of a vehicle of a company that's already learned to provide value to the marketplace. But if you can provide your own value, or at least think outside the box about opportunities where that could even happen, that's a great way to just know that there are other paths out there than just the linear path. And I'm not saying the linear one is bad. It's just good to know that there are options. And I was very focused on the linear path for a long, long time until I started to change my thinking.
right. And I don't think delaying the potential for being happy with what you're doing just because somebody says you have to do 4 years of college, I don't know if that's really the smartest way to go. And industry is not recognizing it as much as they used to. Yes, the check mark is still there, but I think it's going to go away more and more and more, especially now that you can get your degree with ChatGPT.
Yeah, no, you raise an interesting point because I think right now there's still a blend. I think when people are hiring, they like to see the pedigree of the bachelor's and whatever other initials come at the end of your name. But the truth is, some of the best operators that I worked with only had a high school education because they basically learned how to put together a great business, like something in the grocery space or mowing lawns or the porta potty business or something where they became operators and delivered a service. There is a blend. I think it's becoming more acceptable now to prove results as opposed to education, but there's also a world where the pedigree education is needed as well. It kind of depends on your audience and where you're headed.
Yeah, exactly. Now the second and final question is, if you could meet anybody you wanted, past or present, who would it be and why?
I would probably choose my one of my grandfathers that I never got to meet. I always just heard wonderful stories about him, and he was the funniest guy in the world, and a lot of life lessons for my mom, and somebody I always wished that I had a chance to meet. And he passed away before I was born. So there's a whole side of my family that I never really got to get to know that is kind of missing that I see in a lot of other families. So I would say probably him.
Yeah, thank you for sharing that. And Chris, thank you for making the time. We went a little over, but I hope it was flying by pretty fast as it did for me. So one last time, how can people get a hold of you?
Best place is financialmodelingeducation.com. That's where I have all my courses, and I'm also reachable there. And then lastly would be on LinkedIn.
Awesome. Yeah. And LinkedIn, I will actually start following you.
Sounds great.
Thanks again for being here. Have a great rest of your day, Chris.
Thanks. No, thanks so much for having me. I really appreciate it.